clarification on sale of shares and securities, whether the same is classifiable as business income or capital gains. As you are aware, there were many judicial precedents and discussions on the categorization of such income which is arriving from sale of shares. The jurisprudence have largely been in significance for both individuals and corporate taxpayers. While the jurisprudence can be mainly focuses on the intention of the taxpayers, whether they were intent to hold the shares as stock in trade or whether they were intending to hold the shares as investment. This intention could be well elucidated in terms of board of directors meetings or minutes of the meetings in cases of companies. But these kind of intention was hard to judge in the case of an individual. In such situations, there was a problem from a perspective of how do you determine the intention of an individual to see whether he is to be taxed as capital gains or business income. Towards this, the CBDT had sought to clarify this by way of the February 2016 circular, wherein it had clarified that for the purpose of listed shares, please mind this circular is restricted to listed shares, and had clarified that in the case of a listed shares, if the SSE by himself is treating these shares as stock in trade, this is to be regarded as business income. This is irrespective of the period of holding of such listed shares. In a situation where the listed shares have been held for more than 12 months and the SSE is taking a position that they are capital gains in nature, then the same is to be adopted by the tax authorities also. However, once this position is adopted by the SSE, this position cannot be changed subsequently. So this brings about a welcome change in terms of clarity, so that the person is clear on how to tax and what is the nature of the income that he is getting. In all other cases, the nature of the transaction is requested to be going back to the old CBDT circulars and the other jurisprudence. So this is quite a restrictive circular which tells you how it is to be taxed in the case of individuals and in the case of individuals who are holding listed securities. Moving on to the next slide, we have the next circular, which is a May 2016 circular on bad debts. Many of you recall the sections of 36 and 36(2). Both sections allow you for the claiming of bad debts as an allowable deduction, and also mention that where it is irrecoverable, it is an allowed deduction. A question point with many tax officers has been, how do you prove that a bad debt is irrecoverable? I'm sure many of us have been on the other side of the table and been asked to provide details as to what are the attempts made to recover the bad debts. In order to reduce such kind of inquiries, the CBDT has now given a circular which specifically states that in a situation where the bad debt has been written off in your books of accounts, the same may be regarded as a valid proof for irrecoverability of your bad debt. This is in line with what the sections provide and also in line with a Supreme Court ruling in the case of TRF Limited, which provides a welcome change in terms of mindset. A kind of a parallels can also be drawn to the amendment which has been brought out in Finance Act 2015. As many of you are aware, ICDS had introduced a lot of procedures wherein you would prepone income and recognize them well in advance of your books of accounts. So a common question was there that my books of account does not recognize it as income. For ICDS purpose, I am recognizing it as income and offering it to tax. Now subsequently, I do not realize this income and I have to write it off from a tax perspective. But my books of account never recognize it as income, so there's no entry which will be passed for the bad debt. So a question was asked, how does this impact in this situation? And the Finance Act had clarified that from a perspective of ICDS, where you are recognizing income because of ICDS, even if it is not passed through the books of accounts, bad debts of such income, which has only been offered to tax because of ICDS, will not be subject to this disallowance for want of being written off through the books of accounts.